So in this conclusion part, just to basically highlight a few areas there where there could have been a bit of error-making situations. In the last part of excess payments, just be very cautious that when we do actually get the excess payment, indeed it's an excess payment to us, but remember that this is not money which was due to us. It's an excess payment which arises as an error which comes about from the debtor's side of things. So he makes payment to us by error. So this is not in any case an income that we should be recognizing. So we should not be recognizing this money as income, not at all. If at all, we should rather try to recognize it as sundry income. And so far as recognizing a debtor, we cannot also recognize a debtor. That's why we can either have to put that money into a placeholder account, be it a suspense account. So those are areas that you have to be very mindful of in terms of the excess payment. And of course, upon payment, when we actually make the reverse payment to the actual debtor, having located the debtor, there are principles that will automatically take place as discussed in our last lesson. So just be very mindful of that. Now, just also taking into account the actual VAT scenario and the actual assumed principles that you should also be mindful of is that a VAT situation can arise in any given way. You can likely get a situation where you're given statements, financial statements. So when you're given financial statements and the question poses you to actually determine as to whether there will be VAT consequences pertaining to financial statements that will be given to you, you need to apply your knowledge in understanding what that kind of situation entails you in terms of your VAT knowledge. So for instance, when you're given a statement of comprehensive income, does that statement in its nature contain amounts which have VAT onto them? Do they contain VAT? Line items within the statement of comprehensive income? The question that you need to ask yourself is that when those line items got to the actual statement, what happened before they got there? Is it not logical to say that we would have processed journals for them to have actually gotten there? And by the time we've processed journals, the actual VAT portion to particular accounts that had VAT implications would have already been taken into account. So when you get a statement of comprehensive income, it therefore goes on to state that those line items that have VAT implications are actually VAT exclusive amounts. So be very cautious about that situation. So when you're dealing with VAT exclusive amounts, how do we get to the VAT portion? We apply the 15% principle, not the actual tax fraction of 15/115, because those amounts are exclusive of VAT amounts. Would the same be the case with the statement on financial position? Again, all those would have basically have gotten to be generalized. So for VAT implicated line items within the statement of financial position as well, most of those line items would also be VAT exclusive line items. However, there are two scenarios that you have to think about very carefully. And those scenarios would be, think about it, your trade debtors and your trade creditors. Why is that? Because you only realize the actual VAT portion upon having issued the actual invoices to those debtors. That is the one part where we say that, so the trade debtors and the trade creditors would be inclusive of VAT amount as per the statement of financial position. Those are the only two line items that you must be very cautious about. And with the same principle apply with the statement of cash flow. Again, most of those line items that would have gotten there, they would have been generalized. But remember, the statement of cash flow, we're basically dealing with cash flow in its totality. Would you not be in agreement in saying there's also a special line item where everything goes in terms of taxes paid? So that's where all your VAT inclusive amounts would have likely also been included in taxes paid, right? So therefore, those would be VAT exclusive amounts as well. But however, you need to go a step further in saying cash flow statement basically deals with cash flow aspects. So this is money items. So remember the principle of VAT, it's based on the area of invoicing or receipt. Whereas with the cash flow statement, you're dealing with cash flow. So that's why you likely be called to process your ledger account in terms of figuring out as to which particular account, if you're dealing with maybe PPE, then you go into your PPE account and saying which account took precedence. So you definitely have to line up your ledger account, and do all that's required of you in trying to work out the area of invoicing or payment. Because by you coming up with like a completed T ledger account for PPE, for instance, that could have likely been bought or sold, you'd likely be going into expansion of PPE, and you obviously thought in your balances, and you likely get through to a value which would likely have been the invoice value, which would have likely have been the earlier part in which VAT would have likely been processed, whereas it could have been in a receipt. Those are just implications that you need to think about. Again, when you get into a situation of denied supplies or exempt supplies or zero-rated supplies, you also need to be very cautious about what the question is asking of you. You may get a situation where a particular employer has bought a bus. A bus as defined is not a denied supply because it has an unladen mass of more than 3,500 kilograms, so it has more than 30 passengers and so forth and so forth. It's not a motor car as defined. Therefore, you can claim VAT on a bus. However, you have to still look, what is the bus used for? If the actual bus is used by a company to transport fare-paying passengers that as per road or rail, that would make that service a denied supply. Therefore, if a bus is purchased for fare-paying passengers, like buses that are in the transport industry, those buses likely do not have VAT implications because they do not qualify as being taxable suppliers. Why? Because fare-paying passengers are basically an exempt supply per road or rail, whereas passengers that are traveling by air are actually standard rated. So there are quite few fine lines in between principles that can be put forward over to you as well. You may likely get a situation again where you've got an insurance payment that is basically an indemnity payment, where You had a motor car that was basically insured, or let's call it, let's rather call it, indeed a motor car that was insured. And this motor car was insured, right? And it was written off. All right, let's rather change it to say we rather had we had a delivery van that was insured, right? And this delivery van had trading stock on it, and it also had, yeah, that's what it had. So if it was a motor car and it was damaged beyond repair, it was written off, the insurance pays out. And what would be the implication for the damaged stock if the stock was also damaged? And let's say there's a third party who happens to be in the car and is also hurt as well. So what would be the implication of that situation? So we went on to say that with an indemnity payment, there's like a fine line where if a car is stolen or written off, therefore there are no VAT implications that arise for that indemnity payment. So if it was a motor car, in that instance there would not be VAT consequences. It would be a denied supply. It relates to a denied supply in terms of the principle as per indemnity payments. If it was a motor vehicle, which is a delivery vehicle, rather, in that instance it's not a denied supply, it's a fine line, so it would have recognized VAT at the normal rate because you're not dealing with a denied supply. Delivery van is now able to process that output VAT for the indemnity that they're getting. Trading stock is also taxable supply. You would have recognized VAT upon having purchased the actual trading stock, and having purchased the trading stock, input VAT was recognized. So there also be output VAT implications for that damaged stock having to be indemnified. Whereas you're dealing with a third party, which would have also been paid out, but you are paying the third party as the employer. So there would be VAT implications to you because, as the employee, because it's assumed that you basically had a contract with the insurance company. The third party didn't have an insurance company. Even if the actual amount was paid over to him, he did not have an insurance policy or contract with the insurance company. You, as the employer, had that contract. Therefore, the implications of VAT would be basically liable over to you, where you'd have to recognize output VAT on that actual indemnity payment paid over to the third party. And you'd not recognize it at the tax fraction of 15/114, but you'd likely have to recognize it at the straight 15% mark. So these are fine lines that you have to think about. You get like building which is partly making exempt supplies and is partly making taxable supplies. Perhaps it's making 60% taxable supplies and perhaps it's making 40% exempt supplies. You have to apportion in that regard, and you would likely be basing your VAT on the 60% portion, but you cannot claim for more than 60% yourself. Everything has to be in marriage in terms of your inputs and your outputs as per VAT. Those are situations you need to think about. commercial accommodation, you need to remember as well that voluntary registration for commercial accommodation, it's increased to 120,000 rands as opposed to 50,000 rands. And the threshold for compulsory registration for any one company is 1 million rands. Those amounts that are basically stating as to whether you'd be a VAT vendor or not, they have to be VAT exclusive amounts. These are conversations that you have to be getting yourselves into. Again, if you have VAT vendors that are basically have a turnover of 2.5 million rands or less in a particular 1 year, automatically those VAT vendors are put on an invoice basis. And sorry, not on a payment basis. They are automatically put on a payment basis if they are making turnover less than 2.5 million rands, which is in a way giving them a bit of an advantage so as for them to not be out of pocket. However, if that same vendor trades with transactions that are more than 100,000 rands, automatically they get put back on the invoice basis, irrespective of them having an income of less than 2.5 in any particular year. As long as the particular transaction exceeds 100,000 rands, therefore they automatically have to be based on the invoice basis. There would be certain situations that you need to be constantly thinking about. So that is interesting in that regard. We are not perfect, we're just basically trying to share the bit of knowledge that we have. It's also a learning journey for us. So we are in this platform to basically walk this journey of being an accountant and having to also be a better accountant in industry. And tax in this regard is a very critical aspect of this accounting picture, and so would be financial accounting, auditing, corporate finance, and management accounts. However, in this lesson, the primary focus is strictly for tax, having started with that. We will go into our next lesson, which might likely mark our next lesson to be our lecture 2. If there's anything that you feel like needs a bit more of attention, if you feel like there were errors made, please do not shy away. Drop a remark and just let us know where we could likely improve or likely look into. And if there are other principles that would have likely changed or new principles that I'm still also not aware of, please bring that over to my attention as well, because bear in mind, our principle emanates from the knowledge that we gathered from 2020. So this is where we are, and we hope to see you in our following lesson as well. Excuse the course fault. All right.